Hello everyone, welcome to my channel, welcome to the slaughterhouse, and get ready for episode 2 of this channel. In episode 2 I will dive deeper into the financial markets, and I will do my absolute best to educate you on how the financial markets actually work. This video is mainly aimed at anyone who is interested in trading investments. It doesn't matter what type of financial security that you like to trade or that you want to invest in. The financial markets in general, the ones that we can access at least as normal retail traders, are all based on the very same foundation. So I will give you a lot of wisdom today in episode 2 that you can use for your trading ventures. So before I dive into a chart, an example chart, I like to start at the very beginning. In this video, I will explain the very core of the financial markets and how they operate. If you are a beginner, a beginning trader, beginning investor, someone who absolutely has zero understanding of finance, this video might be a bit too advanced, but I will explain everything in such words and such easy concepts that you will understand the broad message of this video. And it will actually benefit you, because if you've never traded, if you've never invested, please watch this video, please study it thoroughly before you ever risk any money in the financial markets, because you will be ahead of more than 95% of the traders by understanding these concepts of the financial markets. It will actually allow you to win, and to win not because of experience but because of wisdom. Because guys, more than 95% of all traders lose money. They do, because they don't understand how the markets work. Many of these 95% traders actually are experienced traders. They have gone through tons and tons and tons of books. They understand technical analysis, they understand fundamental analysis, they understand how to read candlestick charts, they understand how to read every metric, and they understand most of the indicators. They understand how to make a system, a trading system, which is basically just a set of indicators combined that will allow you to operate in the financial markets and to make educated guesses. But still they lose most of their money. Why? Because in trading, you do not win by understanding indicators, by understanding candlesticks. You can only win in trading by understanding how the markets operate. If you don't understand, you will be of the losing group. You will be part of the losers. Because finance, especially investment and trading, is a zero-sum game. Most of these traders know this. They know it's a zero-sum game. A zero-sum game means that for every winner, there must be a loser. The problem is that most traders, most people that lose money, even experienced traders, don't want to put in the work to learn how the markets actually work. They don't want to dedicate time to it. They're trying to chase quick money. They're trying to chase quick success. They're seeing online all kinds of videos and influencers telling them that they will make millions and millions by trading, that they can make 10,000 US dollars in an hour, in a day, in a week, in a month. They are chasing money, and they just do not put in the time and effort into educating themselves, bettering themselves, learning to know themselves, the psychology of a trader, And that is a guaranteed, I'm promising you, a guaranteed road to failure, to losing all of your money. And hey, take it from me, I've been trading for years now, and I have done it all. I have blown up account after account. I've made the same mistake over and over again. I've done it the hard way. And it's not funny, because I've lost a small fortune by being one of those people that belongs to the 95%. And what I've learned is, after these many years of trading, is that it's not indicators, it's not a skill. Trading is extremely simple. Trading, in fact, is easy. Trading is just like any other business. A business, as a concept, has the purpose to make money. It has the purpose to turn over a profit. Of course, there's a few outliers like non-profit organizations, but in general, people start a business to make money. And if we look at the economic concept of a business is an entity which will practice a certain activity, and in this activity it will transform resources into either a good, a product, or a service. And then it will try to sell this good or service to the public with the hope of turning over profit, making money, right? That's the very core concept, economic concept of a business. Trading is the same thing. It's a business and it wants to generate profit. But there is a core aspect to the business of trading that makes trading so stupidly simple and easy. And that is that the business of trading does not require you to have resources which you will transform into a good or service and that you have to sell. Trading does not require you immense capital investments upfront before you can even make a profit. Trading is super simple. Trading is opening an account, just having a laptop, which most people have nowadays, even not a laptop, a phone, a smartphone. That's enough. You open up an account, you will deposit the minimum amount that is required in that account. Some accounts will let you start with, let's say, $100, so you don't need a lot of money. And you will just analyze the markets. The market either goes up or down or sideways, depending on your trading style. And your sole purpose is just to be on the right side and to make a profit. That's it. Really, that's how stupidly simple trading is. Now, the difficulty in trading comes not from the activity itself. Trading is easy. Everybody can trade. Everybody can click a few buttons. Everybody can analyze a chart and see it goes up and down, right? Anyone can do that. The difficulty in trading is all mental. There's two aspects to this mental difficulty. First of all, you are managing your own psyche, your own emotions. This is the most difficult thing any human being can do. That is managing your own emotions, your own thoughts, your own psyche, and not only managing it, correcting it, actually holding yourself accountable for your flaws, the mistakes that you make, your wrong thinking, your impulsive thinking. This is extremely difficult, guys. And the second part of the trading difficulty is studying, learning, advancing your knowledge on the financial markets. Because let's be honest, guys, finance, banking, trading is, in my opinion, the most complex industry and invention of mankind. There's a reason why most people fail, why more than 95% of the people fail, because it's so complex. To find out how these markets work, how all of the entities work, how money in itself works, what the differences are between the different securities, financial instruments, it's so damn complex. But the beautiful thing is that once you've mastered this part of the trading difficulty, just studying, educating, putting in that hard work, that time, that energy, then you will be able to easily make money without much effort. Because that's what trading is. The moment you hit that threshold of advanced knowledge, you can just trade. And you can make tons of money in minutes if you're scalping, seconds, in hours, in days. Amounts of money that other people can only dream of. So that's why I initially started this channel, guys. To explain all of these things to you. To help you. Not for my own beneficial outcomes, not for my own profits. It's a new channel. It would be nice if I can actually do this full time. But my core purpose is to help you and to give away immense amounts of wisdom, knowledge that most of you will not even gain if you had to do it yourself, if you had to research everything yourself, if you had to lose the amounts of money that I personally, for example, have lost learning to trade. Most of you will never ever reach that point. Most of you will actually fail and quit long before you reach the level of advanced knowledge. And that's why less than 5% of traders succeed. And I'm giving you the opportunity to become part of that 5% in a very short time period. So yeah, that's the base of my channel. So, okay, let's continue now and jump into it. In this video, I like to focus mainly on the financial markets and how the market operates. So I'm not going to talk to you about technical analysis. I'm not really going to talk to you about fundamental analysis. I'm not going to talk to you about indicators. I'm just going to start with the very foundation, and that is understanding, knowing how the financial markets work. Most traders, especially beginners, but even the advanced ones, the experienced ones, believe that retail traders move the markets. A retail trader is anyone like you and I, a regular person sitting at home, usually having a job, earning a salary, and someone who opens a trading account for any reason possible. They might have seen it online, they might have heard it from a friend, family member, doesn't matter, university, doesn't matter. They open a trading account, deposit some of their savings in it, and hope to make profits with that money. Hope to turn it into their occupation, their job, right? These people always believe that the markets are designed, are built, operate on similar people like themselves. They sit there behind their computer or smartphone, looking at the chart, believing that there's billions and billions and billions of people like them having a trading account, looking at the same thing, thinking the same thing, seeing the same thing on the charts, believing that they move the markets. And these people also believe that when they are trading, that they are trading against other retail traders. But this is not how the markets work, guys. This is completely false. This is just an illusion. It's a delusion. It's false thinking. It's ignorance. It shows that the person trying to trade has zero knowledge on the financial markets, on finance, and it's the guaranteed way to losing all of your money. And you will. If you trade like this, you absolutely will everything. You will blow up your first account, you will blow up your second account, maybe your third, maybe your fourth. Plenty of professional traders today that actually make a lot of money have blown up tons of accounts, guys. Because they had to learn it through experience like I had. I'm just giving it to you. You can consider yourself very, very lucky. Because this can change your life, this knowledge. So, having said this, that retail traders do not operate the markets, they do not move the markets, who does? Where does the market even come from? Where does the charts come from? How can it be that it moves around, that price goes up and down? And this is the very foundational level, the foundation, the bricks of the financial markets, and that is that there is a different institution that creates the financial market, that creates the chart that you see, that creates a price action, the order book, that creates all of this. Everything that's provided to you through your brokerage account, everything that you use to trade, that's all created by an institution called a market maker. A market maker basically creates the markets. Now, what's a market? Very basic economic concept. A market is a place where you have a buyer and a seller, and they try to transact a certain product, let's say. In finance, in trading, that's a financial security, an asset, right? Stock, cryptocurrency, futures, options, right? Bonds, whatever, gold, commodities, whatever you can imagine, right? Any of these assets, let's say, let's call them all assets for now. Not all are, but let's call them assets. Any of these. So the buyer and the seller want to transact. One wants to sell, the other wants to buy. That's the traditional definition of a market. Now, in the financial markets, in the financial market itself is based on the very same economic concept where you have a buyer and a seller, but to create the market, the financial market, you have the market maker that's an intermediary. Market maker will come in between the buyers and the sellers. Why? Because financial markets, if they would solely be based on retail traders, retail buyers, retail sellers, would be very illiquid. There would not be enough money, not enough liquidity to actually trade efficiently. So what does efficient trade mean? What are efficient markets? An efficient market, let's say, would mean that at any price imaginable, someone would be able to buy and someone would be able to sell whatever they're buying or selling. In an inefficient market, which would be the financial market without a market maker, that would mean that not at any possible price a match between buyer and seller would occur. It would mean that there would be gaps. And a market maker has unlimited liquidity. They basically have unlimited capital, guys. That's why they make the market. Because they come in between and they will start to match up buy orders and sell orders. And they will provide liquidity. So what they basically do is they will prevent the market from being inefficient, from gaps to occur, and they enable us, the retail traders, to buy and sell at any price. That's what they do. And that's a good thing, because that makes trading possible. Without the market maker, we would not be able to trade. We would not be able to transact. We would most likely lose even more money, honestly, because when price gaps, that's a big problem, right? As orders won't be filled, stop orders won't be filled. That's a big issue. It would actually increase the risk for you as a retail trader. So I already told you that most people believe that they as a retail trader are trading directly against other retail traders. You're not. Every single retail trader, everyone that opens a trading account, even institutions, even hedge funds, even investment banks, whatever it might be, money managers, doesn't matter, asset managers, they are all trading against who? They are trading against the counterparty, which is the market maker. And in trading, the very basic concept of a trading platform and account or financial market is that you will have an order book. So what the market maker does is you have the order book with the buy quote and the sell quote, right? The bid and the offer, the ask price, the offer price. And you will see that the buy quote and the sell quote are always slightly different. So let's say you can buy for $10 and you can sell for $9. Why is this so? It is so because the market maker, first of all, creates the market and he creates the order book. He is the counterparty. The market maker is actually telling you with the order book, if you want to buy from me, the market maker, you will have to pay me $10 for, let's say, this stock, right? But if you want to sell your stock to me, you will have to pay this selling price. In other words, if you look at the buy quote being $10, the sell quote being $9, the market maker is telling you, you can buy from me for $10, but you have to sell it back to me for $9, which means that you make a loss of $1. That loss for you is the profit for the market maker. This difference between the buy quote and the sell quote is called the spread. The spread is the profit for the market maker. And that's the thing, guys. A market maker, in the end, is just another business, and it will actually adhere to the definition of a business, which is an entity practicing a certain activity, trying to make profit. The market maker wants to make profit. So here's the interesting thing. Financial markets are a zero-sum game, which means that for every participant, for one side in the market to win, the other side has to lose. So if the market maker is one side and the retail traders are the other side, that means that the market maker needs you to lose money for him to win. And you need the market maker basically to lose money for you to win. Market makers usually don't lose because they have, as I said, unlimited funds, unlimited capital, unlimited liquidity. You don't. You cannot take risks like a market maker. A market maker can place buys and sells, and he can just leave them right there, and the market might, the price might go against his trade, but he knows that at some point it will just go back to that price, return to it, and he will make a profit. If you do that, you will get liquidated and you will blow up your account. You cannot blindly. Trade, place an order, leave it there. Unless you're investing, buying and holding, yeah, you can. Let's say Bitcoin, you can buy Bitcoin, or you can buy a fraction of Bitcoin, spot, for the spot price, no leverage. You can hold it. Price will go up, price will go down. So as long as you don't sell it, you won't lose money. But we're talking about trading. And most trading is done with leverage. And that means that you cannot hold, because you first of all have to pay interest on the leverage, and secondly you will have to pay margin. You have to put down some margin, and if the price goes against you, it will hit a certain level, your liquidation price, and you will lose your money automatically. So what you have to do as a trader is you must learn to understand the market maker. You must learn your enemy, let's say, even though it's not really an enemy. It is needed. It's both your friend and your foe. You have to love him and hate him, the market maker. But you must learn him. You must learn, study how he works, how he operates, how he controls the market, because he does. He makes the market go up, he makes the market go down. He is causing price to move. And if you want to win, you must be on his side, not the retail traders. More than 95% of retail traders lose money because they don't know, they don't understand. So that's the theoretical part of the market. I've given you the foundation. I've given you the very definition of a financial market. This is how it works. This is how the market maker operates. And you should know by now which side you are of the market. You should also know by now that the other side is the winning side. So what you have to do now is you have to learn how to trade like the market maker. And for this, I actually have a screenshot of the Bitcoin chart. So this is, let's go to it. This is BTC USD. Doesn't really matter what chart you use. All of the markets that you will trade will work the same way. But in this daily Bitcoin chart, you will see a clear example. And I've highlighted a few things. And let's start with the beginning. So the chart will actually tell you what the market maker is doing. That's all it's doing. The chart is a language. You either understand the language or you don't. So what you have to do is you have to learn to understand this language, the chart, price action, candlesticks, and you must learn how to translate it. And you must learn how to make sense of it. That's all you have to do. As I said, it's simple. It's stupidly simple. Not easy, but simple. Now, if we look at the charts, I'm going to show you where I like to start. You see December, zone 1, the purple box, the purple rectangle. I like to start over there. If you look at the candlesticks, if you look at the price action, you will see it is consolidating, it's going sideways. It's in a zone. I call it zone 1 in blue, as you can tell. In this zone, this is the zone where a lot of orders are actually placed and waiting to be fulfilled. This zone is actually a zone of efficiency. Why? As I've said, an efficient market means that at any price you can buy and sell. When price action is in a zone, Basically, it has cut off a certain range with a high and a low, and it is consolidating, it's going sideways. It's in a zone. I call it zone 1 in blue, as you can tell. In this zone, this is the zone where a lot of orders are actually placed and waiting to be fulfilled. This zone is actually a zone of efficiency. Why? As I've said, an efficient market means that at any price you can buy and sell. When price action is in a zone, basically it has cut off a certain range with a high and a low, and between that range all the orders are getting filled. In certain terms we call it an order block, this type of zone. Consolidation, it's the same thing, order block, consolidation. The only thing you have to understand is when you read the chart, you must understand that this zone, this consolidation, is actually efficiency. Retail traders have their orders right there. Could be buy orders, sell orders, could be stop losses, take profits, doesn't matter, right? But the orders are getting filled, and you can tell. Now, the thing is, as I've said, without a market maker, the markets are not efficient. Which means that at some point in time, this zone, this consolidation, this zone where orders are getting filled efficiently will end because of the activity of the traders going down. And that's what you see when price goes sideways. You see that the activity gets less and less and less, right? The swings from the bottom of the range to the top of the range get smaller and smaller and smaller. Why? Because liquidity is drying up, and that's mainly retail liquidity. It's becoming inefficient. There might still, when the price action becomes narrower, right? When it starts to narrow down and you're not having those swings within the range, you still have buy orders and sell orders at the top of the range, but they're not getting filled. So inefficiency starts to creep in to the market because retail traders do not move the market, and they are not liquid enough to just trade and make a move. So if you look at zone 1, the purple box at the bottom, if you go to the right side of that box, you see that the price starts to consolidate more and more and more. It starts to slow down. It looks like it's barely moving up and down at some point. And this is inefficiency. Inefficiency starting to creep in. It's the very beginning of the inefficiency. And what happens next is you will see that at the end of the box, you start to see a lot of green candles, and it will actually break the upper band of the consolidation zone. It will break to the upside with big green candles. And this move in total is inefficiency. Why? That's actually the market maker pumping liquidity into the market and causing a big move, in the meanwhile filling up orders of people, retail traders, but also placing orders that counter the orders of retail traders. So when you see that big move up, basically imagine that those big green candles wouldn't be there and you would see a gap, right? That's inefficiency. Gaps are inefficiency. Gaps mean that within that price range where the gap is, people were not able to transact. But because the market maker can inject a lot of liquidity, you see that they just buy up everything. They bought at the bottom of the zone during the consolidation. That's where the market maker buys, because the market maker is in the business of making money. They will buy when it's low and they will sell when it's high. Buy cheap, sell expensive. That's how you make money. When you're short, you sell when it's expensive and you buy when it's cheap. It's just the opposite. So what happens is, if you look at the first move up with the green candles, I drew a line, a blue line. I called it A. That's move A. Move A to the upside. Move A, as you can see, actually stalls. It stops for a moment, and that's at the previous support and resistance level, the previous consolidations. If you look to the left, you will see price did the same thing at those points. And that is because the market maker bought very low in the zone, in zone 1, in the purple box, and he's now actually selling to the people, retail traders mainly, that think, oh, I see green candles, so now I have to jump on. The market maker is actually selling to these people with a profit. So you again see at zone A a small retracement, a small consolidation, and that's basically where the market maker is already taking profits. That was move 1. Move A was move 1 up, small retracement, and then again, when the price dropped a bit, the market maker was actually already had buy orders, started buying again. Again, you see a green candle, which is inefficiency. You see that right there, the market maker is actually moving, injecting money, moving the market. And again, you see that big green candle. You see you see leg 2, which is the second leg up, leg B, I've called it, starts to slow down, right? And that's again where the market maker starts to sell again to the people that are buying at the top of the second move up, of second move called B. Again, you see the price drop and consolidate, and then you will have the third leg up, which is leg C. And leg C goes all the way up into the consolidation zone, which is zone 2, the purple box in the middle. And if you look to the left, you see that was the previous point of where the market maker consolidated, basically. And why is that so? Why does it exactly hit this box of consolidation? Because if you look to the left, all the way to the left of the chart, right, of zone 2, that box where you see that price was consolidating in the past, the market maker at that point also placed sell orders at the top, which were not yet executed. So the market maker just first brought price down to zone 1, and from zone 1 brought it all the way back up, and then it reaches zone 2 again in the present moment with leg C up, and starts to fulfill these sell orders right there from the past all the way on the left side of the chart. The market maker is basically moving the price towards his previously set orders, because he sets the orders up front. That's what he's doing. Another thing that you have to notice and know is that usually market makers will move the price in three steps. That's why I have from zone 1, leg A up, small retracement, leg B up, retracement, leg C. It's moving in 3 movements, right? 3 parts. Why is that so? Because the first movement is where the market maker actually bought at the very lowest level. So he went not all in, but placed big orders, right? You see big green candles. Then he will sell to the people that are jumping on the bandwagon, because people usually wait and they think, oh, now I've seen a big move up, so I have to buy too. So that's when you see that small first retracement. That's when the market maker starts to sell off to the people that jump on. But he knows that some people actually wait for this retracement to jump on. So then he will move up again, and he will have move 2, move B, And at the top, well, during move B, he is selling again to the people that are buying and starting to jump on also. You will see the retracement, and then you have move C. And then it goes down. So as you can tell, you have higher highs, higher lows until the end of move C, and then it will crash down. Market makers almost always follow these 3 steps. You don't have to look up another chart actually, because if you look at any other big move, you will again see that it moved in 3 steps. That's just how they move, because they play into the psychology of the retail trader. And when they are selling, they need you to buy. So they're playing reverse psychology. And when they are buying, they need you to sell. It's all about psychology. And you cannot trade with the psychology of a retail trader, because you will lose money. You must trade with the psychology of the market maker. And that's how you will make money. So I hope this is clear actually. I'm sorry that it's a picture. At the moment I had an issue with my editing software, and it just did not want to accept the video that I had of this chart, in which I could explain it a bit more in detail with using my my mouse cursor to point out certain things. But I think based on the zones and the lines, etc., and the explanation, you'll have a good understanding of how it works, because it's simple, guys. I told you it's simple. It's not complicated. It's very simple. If you don't understand it yet, watch the video again and just study it again. And maybe first, if you just don't understand the concept of consolidation, Google it first and then come back to this video and analyze this chart together with me and with my explanation. Please like this video, leave a comment. Please let me know if you like these longer videos or if you want shorter videos. Then I will do my best to make videos that will last a bit less long, right? And yeah, please subscribe to the channel. I really need that. I will need your support to continue making these videos, to continue sharing the knowledge that I have for you to win as a trader. So please subscribe, click the bell button, leave a like, leave a comment, and I will see you in the next video. Okay, bye guys.